liabilities. So when we add up the different figures, we get 210. Okay? The difference, the excess between book and fair, 210. But we're over 235. So we'll allocate $25,000. When you don't have any other specific assets to allocate it to, it's going to go directly to goodwill. So we're going to allocate the excess, $25,000, to goodwill. We see our trademarks are indefinite, but we have estimated years on the other amortizations, the patented technology, the equipment, and the liabilities. So when we carry those out, we have an excess amortization annually of $10,000. Okay? This is very similar to what we've done in the past. Now, how are we going to allocate this information to the controlling interest and the non-controlling interest? What we're going to do is we're going to look at the identifiable assets. And if we show that the fair value is $975 and we take 80% of $975, we should end up, where does it show the net identifiable assets of $950? That's where I want to get in the book. Let me go into this book real quick because it gives us a little more information. Excuse me, let me go here. At fair value, I'm trying to find out the fair value. Okay, it does have the fair value of the identifiable assets.
It just says net assets.
Oh, here it is. So this is how we're getting this figure. The book value they show at $740. They show the fair value at $950. Okay? So if we go back to the PowerPoint here and we see that the fair value of the assets are at $950. We're going to take 80% of the fair value of these assets and allocate it to us. We'll take 20% of the fair value as allocated to the non-controlling interest. And the difference is what we will each have as goodwill. We know the total goodwill needs to be $25,000. Okay? But you see how we're not allocating this goodwill proportionally? We're allocating it based on the fair value of the acquisition. Well, we aren't in this case, allocating it proportionally, 80 and 20, okay? So in this case, the goodwill of 25 is going to be allocated 20 to us, 5 to the NCI, non-controlling interest. Does that make sense? So basically, as it relates to combining these companies, we see that in retained earnings since the acquisition, they have net income of 90, they paid out dividends of 50, and then they have the increase they flowed back into the retained earnings is 40. In 2014, they had a $70,000 increase in retained earnings. So if I go back here to the book, that gives us the fair value. As we look here, we understand how they're allocating goodwill. Assuming that King is going to apply this equity method, we're going to now look at how they're going to account for this information related to the non-controlling interest. So let me go back here. I apologize, I keep jumping back and forth. Whoops. So, okay, where am I? So, what we'll do here is we're looking at the revenues here of King, and we're looking here at the income statement here of and balance sheet of Pawn. We see that their net income here is $90,000. Okay, we see that they declared dividends here of $50,000. So that shows us an excess into retained earnings of $40,000, right? Now, in order to close out or eliminate some of the equity section of the subsidiary, what we're going to need to do is create some journal entries. Okay? So in this scenario, we are going to need to eliminate Pawn's common stock, which do you see right here is $230, Pawn's common stock, because we want to treat it as one company. So we're going to need to eliminate the stock of the subsidiary because we own 90% or 80% of this company. So we're going to eliminate the stock here of $230. So the first thing we've done, common stock, $230. We're going to go back and look at Pawn's retained earnings at the beginning of the year. Do you see here how their retained earnings at 1/1/2050 is $580? We want to eliminate that. So we're also eliminating the retained earnings of $580. Then we're going to take 80% to wipe out our investment in Pawn, and then the controlling interest in Pawn, the non-controlling interest of Pawn of 20%, we're going to allocate in our equity section for the non-controlling interest on the consolidated financial statements. So this basically eliminates the stockholders' equity section in the subsidiary, eliminates the common stock and the retained earnings at the beginning of the year, and we take 80% of this, apply it to our investment, 20% gets applied to the non-controlling interest. Now, the A consolidated entry is basically taking into account that unamortized fair value excess to Pawn's assets and to allocate it, some of it to the non-controlling interest, and then deal with the goodwill. So we saw back in this one area, it showed us the trademarks were increased 60, the technology is increased to 120, equipment decreased 10, the long-term liabilities increased 40, and then our goodwill of 20. So we're going to show this A entry to show the increase of book over fair. So we increase our trademarks of 60, we increase our patented technology, our liabilities, our goodwill. Then we are going to show the $10,000 amortization on these. So basically, if we go back here, I apologize. If we go back here, we see the patented technology has a 20-year indefinite life. Okay? So we're going to take 6 on that each year. We're going to take 1,000 against the negative equipment, and we're going to take 5,000 against the long-term liabilities. So in this example, what we could have done is shown the journal entry for 100% of it, and then the next journal entry applied the excess amortization. They're doing this in one step here. The goodwill cannot be amortized, and the trademarks cannot be amortized. The patented technology, the allocation of excess over book value was 120, but we're taking our annual amortization here of 6 against that. The liabilities, we're taking our annual amortization of, how much was that? 4 against the liabilities. And then our equipment, we're amortizing that over 10 years. So we're taking 1,000 there. So basically what we're doing here is showing this excess accumulation, the 235, remember that figure? We're taking 80% of it and applying it to pawn to wipe out that investment section for pawn. And then we're taking 20% and applying it to the non-controlling interest. So it's very similar to what we've done in the previous chapters. The change here is, instead of applying everything against the parent, we now have to allocate it among the non-controlling piece. Make sense? Kinda? How many of you have I lost? Kinda? Okay. Now, we need to take into account some intra-entity income. Sometimes companies trade amongst each other. So that portion of intra-entity income we need to wipe out. Now, I think the book explains that a little better than what we have in here. Let's see here. The 48,000 here, let me look here. Oh, 64,000. Okay, you see this equity in subsidiary earnings of 64,000 here? This figure, because we're trying to consolidate the two financial statements together, and we need to wipe out any equity section of the subsidiary. The way we're going to calculate how much the equity in subsidiary earnings we end up showing on the financial statements is by taking the $780,000 acquisition price. We'll take the retained earnings of the $56,000, which is 80% of the 70. We take into account the $8,000 of the $10,000 of amortization that gets applied to us. And then we look at the income for the year, which was $90,000 on the subsidiaries books. We take 80% of that. We take 80% of our amortization, because we always have to reduce our net income by that amortization. So the income or the equity in the subsidiary for the controlling interest is going to be the $64,000 here. And then those dividends, we're not going to show those dividends. You know, we basically reduce, depending on which method we use, they distributed those dividends. But for our purposes, because we need to show equity, the income, that portion of the income as our equity in it, we're going to take for $64,000. So if we go back here, we're going to show the $64,000 of our share of the income from the subsidiary. We're going to reduce our investment in that amount. Then this $40,000 will increase investment in pawn and credit our dividends declared, similar